Cryptocurrency price follows the simple economics of demand and supply, but there are some other factors as well. Cryptocurrencies have been available to the public for nearly a decade now, but their popularity is a relatively new phenomenon. A lot of people have now started investing in one of the many digital coins available today. The process of creating these coins, called mining, is limited to the geeks, who work on powerful computers to solve complex mathematical equations to create virtual currencies like Bitcoin, the oldest and most popular of them all. Based on the idea of decentralization, the blockchain technology behind these coins plays an important role in sustaining them and making them secure. How does cryptocurrency work and how is its value determined? To understand that, we need to first know how a cryptocurrency is different from a fiat currency, Indian rupee, US dollar, etc. The biggest difference is that a fiat currency is backed by governments and declared as legal tender. It derives its value from the fact that two parties in a transaction put their trust in that value. Most countries operate in a fiat currency system, where central banks and monetary reserves control the supply of money, and, as such, indirectly control inflation. Cryptocurrencies are not regulated by governments, they are decentralized. Most countries are yet to accept them as legal tender. Cryptocurrencies will also generally have a fixed supply, therefore their devaluation through inflation is unlikely. Other than that, both have similar characteristics. Both can be a medium of exchange to buy products and services, and both have a relative store of value. Supply and demand. The value of anything is determined by supply and demand. If demand increases faster than supply, the price goes up. For example, if there's a drought, the price of grain and produce increases if demand doesn't change. The same supply and demand principle applies to cryptocurrencies. The most effective way the price of a cryptocurrency coin is determined is by its demand. Heavy demand from buyers will push the value of a digital coin upwards. Conversely, if a coin has a high token supply with little demand, then its value will drop. Other factors that influence the price of a crypto coin include the level of token utility, i.e., how useful the token is. A difficult mining process would mean it is more difficult to increase the supply of the coin and cause upward pressure on the price when demand is high. Demand can increase as a project gains awareness or as utility increases. Broader adoption of a cryptocurrency as an investment also increases demand while effectively limiting the circulating supply. For example, when institutional investors started buying and holding Bitcoin in early 2021, the price increased significantly as demand outstripped the pace at which new coins were created, effectively decreasing the total available supply of Bitcoin. Cost of production. New cryptocurrency tokens are produced through a process called mining. Mining for cryptocurrency involves using a computer to verify the next block on the blockchain. The decentralized network of miners is what allows cryptocurrency to work as it does. In exchange, the protocol produces a reward in the form of cryptocurrency tokens, in addition to any fees paid by the exchanging parties to the miners. As mining costs increase, it necessitates an increased value of the cryptocurrency. Miners won't mine if the value of the currency they're mining isn't high enough to offset their costs. And, since miners are essential to making the blockchain function, as long as there's demand for using the blockchain, the price will have to go up. Competition. There are thousands of different cryptocurrencies in existence, with new projects and tokens launching every day. The barrier to entry is relatively low for new competitors, but creating a viable cryptocurrency also relies on building a network of users of that cryptocurrency. A useful application on the blockchain can quickly build a network, especially if it improves upon a limitation of a competing application. If a new competitor gains momentum, it takes value from the existing competition, thus sending the price of the incumbent down as the new competitor's token sees its price move higher. Availability on exchanges. If more people invest in a crypto coin, its value can shoot through the roof. Still, these virtual currencies are far away from being adopted by the masses. Why? Because there are real-world problems associated with them. 1. They cannot be exchanged for goods and services as widely as a fiat currency. For these digital coins to gain mass adoption, their utility has to increase and the deal should appear lucrative to the buyer. The cryptocurrency market is still new and a lot of people are not yet familiar with the industry. New markets have qualities that make them inherently volatile. Then, there are some whale accounts that hold a large number of cryptocurrency coins and tend to influence markets to book profits. If you understand the core principle of supply and demand behind what gives cryptocurrency value and the factors influencing them, you can make better cryptocurrency investment decisions. If you believe demand is going to increase for reasons X, Y, and Z and don't think supply will keep up, that cryptocurrency could be a good investment. But be aware that governments still don't have best practices for regulating cryptocurrency, which makes it a particularly risky and volatile investment no matter what.
If you enjoyed the video, please like it, and to learn more about cryptocurrency and financial knowledge, please subscribe to my channel.